Do you want to share your screen, or what all do you
Sure.
need to explain this hedging strategy?
Mm.
Because I feel like, Chris, correct me if I'm wrong, it kind of changes the game in terms of how close you're able to buy a stock before earnings.
Right, definitely. First, we'll just look at this. So when it was moving out the other day, I decided to go ahead and buy it. And yeah, so it started moving, and I waited until kind of midday and then got into it, and then it surprisingly really took off the next day, and today it's holding up well. So I've got definitely a profit in it going into earnings. And so what I'll do is what I did with Coupang, and I did the same thing with Coupang last week or earlier in the week, where I put a half hedge on it. I used a 50 delta, and basically at the when I sold it, I think I was getting about, I only took 30% of the loss. So it was, let's say it was down 10% at the time, then I was down 3% on it. So that's why this is really making a lot of sense for me. And in the same way, when I did TSM a week ago and I was doing 25 deltas, and it gapped up, and I captured almost 80% of the gain, even though I was half hedged, because when the
TSM?
stock, yeah, when the stock rises like that, the option goes to zero, and so it's not really affecting it any longer. Okay, so I'll share my screen now. So here's the options, and uh, so what I do is I'll use the weekly option. So on Monday, and let's say it's trading at this level right in here. So I'd probably do the 87, and I would. So if I had for every 100 shares, I would buy one put, and then just see how it moves on the earnings. And if it gaps up, this is going to drop off quite a bit. And actually, this is kind of I mean, this will be a little more inexpensive on Monday, but it's you're still you're putting out $5 on an $86 stock. So it's the the percentage is large. But if this thing really goes up, 10% or 15%, you'll still be making quite a bit of money. Um, and if it gaps down, then this thing will go into the money, and instead of a 50 delta, it'll be, let's say, in the 70s or something like that. And that's why it works so well on either side, because the delta, if it gaps down, the delta gets bigger. If it gaps up, the delta basically goes to nothing. So that's um, the approach on this one. And if we look at Zeta, now Zeta.
The expiration here, by the way, Chris,
Mhm.
is the weeklies, correct? Right
Yeah,
after
yeah, right.
earnings.
I'm always using the weeklies, so that's because you don't want to get uh, you know there's nothing gained by buying time. It's just raising the cost of the hedge.
So if it reports on a Thursday, would you still buy the weekly
Oh
of
yeah, that's even
week?
better because it's
Okay,
cheaper.
got it.
Yeah. Uh, so in this case, I tried Zeta here when it first came up, and then it fell back below the 50-day. I got out, and then on Tuesday, um, before the election results, I decided, you know what, I got to get back into this. And the only regret is I didn't go bigger than I did.
Mm.
But this thing has really taken off. Again, this makes me nervous because this sort of action right ahead of earnings, there could be a gap down. So for the same element, let's put in Zeta. And in this case, Zeta does not have weekly options. However, the monthly option is going to be expiring next week. So it'll be the same effect as a weekly. And again, right now, this is, fairly pricey. It'll be somewhat less on Monday afternoon. Maybe we'll see how it goes. But by the same token, what I'll do is, so there's a big gap between these two strikes, and the delta is 45 and 66. I'd still probably go with the 45 and buy one for every 100 shares, and then just see how it goes. Because if it really moves, that delta will disappear, and I'll still grab most of the gain. And if it gaps down, it will jump up in volume, in value, and I'll be hedging myself on the downside. So that's the strategy that I'm using with earnings right now. And it's making me, Mike and I have talked about this, and it's making me to want to buy things that I normally wouldn't ahead of earnings. But if the setup looks good, I mean, they're in a base, they're getting support at the 50-day, or coming off of a 21-day pullback, I may just start buying positions and hedging them going into earnings, and just trying to because in this market, if I had done that on so many stocks, that this week would have been, it's already a great week. It would be, a fantastic week. So something that I'm considering, and it'll really come down to position sizing and how aggressive I want to get.
We've talked about recently, I'm going to start once I'm not an option dude, but once I feel comfortable enough, and I'm glad that you're doing this all the time to make all of us feel comfortable. Yeah, I think that's kind of the missing piece in the post-Reg FD world,
right,
of doing, of approaching it this way. So
yeah, and my feeling is, okay, so I missed out on 20% of TSM's move on its gap up. Who if the thing doubles again, who really cares that you've given up these little slivers of gains on the way up, but you've been able to hold a big winner and sleep well without worrying,
Yeah.
what if this thing gaps down?
So, Chris, I was just looking at some questions in the Q&A.
Mhm.
Can you clarify 50 delta? Because I know you've also talked about the 25
Yeah.
delta.
So Justin and I looked at a lot of these recently, and we're continuing to
Study.
put together data. But what happens is, if the stock gaps up, the 25 is even better. But what can happen is, when it gaps down, and it doesn't happen in all cases, but in some cases, you take a bigger loss than you would have otherwise. So,
So the 50 delta.
yeah, so the 50
Kind of a
delta
happy
makes more
medium.
sense. There's more, you're putting out more money, but again, it helps you on both sides. And instead of, basically, it comes down to this. With the 25 delta, you can get like 80% of the move on the upside, and it will probably be 25%, or in the 20 to 30% range on the downside that you take. And with the 50 delta, it's more around 70% on the upside, that you're participating in 70% of the move, and then on the downside, it's around 30%, where you're only taking 30% of the hit.
Maybe it's one of those things where it also it depends on how much profit cushion you have, what your conviction, if you wanted to do the higher reward, higher risk version, or if you wanted to protect yourself a little bit more.
Well, we were looking at the numbers, and when you actually look, it's like, you know, oh, I took a, you know, a $3 loss rather than a $2 loss, or I, you know, you know, the thing was up $10 and I got 8 of it rather than 7. And it's like, I'd rather
not that much of a
just,
difference.
it
Rather have
just
more
doesn't,
protection.
yeah, the risk reward ratio, there's no reason to risk the hedge not working at all on the downside. So
Okay. So now that you studied it a little more, the 50 delta.
exactly.